Massive layoffs hit U.S. oil majors, even as Washington pushes for more fossil fuels. Here's a scenario that might make you raise your eyebrows. While the Trump administration champions the expansion of oil and gas, using policy after policy to open doors for the fossil fuel sector, the big American oil companies are quietly slashing jobs by the thousands. It sounds paradoxical. Shouldn't a pro-oil government mean more drilling, more jobs, and more prosperity for the sector? But here's where it gets controversial. Despite the recent boom in U.S. oil output, and a government eager to accelerate it even further, some of the industry's giants are trimming their payrolls at an unprecedented scale. Let's rewind a bit. Since COVID-19 upended global economies, we've seen a new chapter for the American energy industry, an era some call the megamerger. In clear, everyday terms, large oil corporations like Chevron, Exxon, ConocoPhillips, and Occidental have spent billions acquiring smaller rivals, both boosting overall production power and absorbing chunks of the workforce in the process. You might expect that such expansion sprees would spell jobs and stability, but reality paints a different picture. With fluctuating oil prices and persistent profitability challenges, these same companies are now making difficult decisions to cut costs, including laying off thousands of employees. Take ConocoPhillips, for example. Just last September, this Texas-based energy behemoth announced an eye-watering plan to shed up to 25% of its global workforce, potentially as many as 3,250 jobs gone by year's end, a significant hit for a company with 13,000 staff. Not long ago, ConocoPhillips purchased Marathon Oil for a hefty $17 billion, swelling its operations and its obligations. Dennis Nuss, a company spokesperson, summarized the painful necessity behind these cuts. The ongoing quest to maximize efficiency given limited resources. The tension is real. Growth through acquisition does not always translate to job security for everyone involved. Meanwhile, the Trump administration has rolled out a host of new initiatives specifically crafted to fast-track oil and gas permitting, making it substantially easier for companies to explore and drill on federal lands. In theory, these measures should drive up production and spark a hiring wave. But here's the part most people miss. Many policy changes take years to translate into real-world results. While today's financial pressures are immediate, oil companies now find themselves squeezed by major investments and shareholder expectations, just as the profits from high oil prices have begun to fade. Let's put the numbers into context. Although oil prices have rebounded somewhat in recent months, they remain well below the highs seen during the initial recovery after COVID. U.S. crude averaged around $64 per barrel this year, enough to keep the drills running, but far from the boom years that saw profits soar. For ConocoPhillips, this translated to a 15% year-over-year drop in second quarter profits, landing at $2 billion. Chevron, another major player and America's second-largest oil firm, is following a similar cost-cutting path. Earlier this year, Chevron revealed plans to trim up to 20% of its workforce by 2026, potentially affecting as many as 9,000 employees. The company has already made waves with mass layoffs, 800 workers in Texas's Permian Basin and 600 in California, all in a single month. Adding to Chevron's turbulence, it lost its license to produce oil in Venezuela, slashing its overseas output. But controversy surrounds another development. Chevron managed to defeat rival ExxonMobil in a high-stakes legal battle over Guyanese offshore oil assets, clearing the way for its $53 billion acquisition of Hess and an expanded foothold in South America. Here's a bold question. Should mergers that promise growth but result in lost jobs and volatile profits be celebrated or scrutinized? And it's not just the oil giants feeling the squeeze. Service companies such as Halliburton and SLB, which provide drilling and other vital oil field operations, have also announced workforce reductions. All told, 22 publicly traded U.S. producers, excluding giants like Exxon and Chevron, have slashed their capital spending by $2 billion this year alone, according to a Reuters survey of second quarter earnings. Why the belt-tightening? Persistently low oil prices have made expensive new drilling projects less profitable, forcing companies from the top to the bottom of the chain to rethink their spending and staffing plans. International dynamics aren't helping either. The OPEC Plus alliance, which groups members of the Organization of Petroleum Exporting Countries with other oil-producing nations, has been ramping up production to claw back global market share lost to the U.S. After years of capping output, OPEC Plus decided to increase supply by 137,000 barrels per day starting in October, putting further downward pressure on world oil prices. Shockingly, oil prices have dropped around 12% so far this year, hovering just above what many U.S. companies need to break even. Industry-wide, the downturn is evident. The number of operating U.S. oil rigs has dropped by roughly 69, now down to 414 rigs, according to the services firm Baker Hughes. Kirk Edwards, president of Latigo Petroleum, described it perfectly. "We've gone from drill baby drill to wait baby wait here in the Permian. Many U.S. producers are now holding back, waiting for prices to rise to the $70 to $75 per barrel range before committing to new drilling. Until then, the machines and the jobs that depend on them remain idle." In summary, the flood of job cuts by America's biggest oil and gas firms follows a period defined by megamerger mania and extraordinary industry spending. Now, as OPEC Plus amps up output and oil prices hover near cost levels, the outlook for U.S. oil workers remains precarious, with more cautious budgeting likely to prevail in the coming months. But that brings us to a controversial crossroads. Should policymakers and executives press for more aggressive fossil fuel expansion, knowing it might not deliver the widespread job growth promised? Or is the industry's consolidation and cost-cutting a sign that the oil economy simply can't deliver the employment it once did, even with robust government support? Let us know what you think. Are these job cuts an unavoidable reality, or could a different set of policies have protected American energy jobs? Sound off below with your perspective, whether you agree, disagree, or have a new angle to share.